Today, another cryptocurrency lender goes pop. Hi again, it's Martin North from Digital Finance Analytics, one latest posts covering finance and prop news with a distinctively Australian flavour. So, cryptocurrency lender Celsius Network has filed for Chapter 11 bankruptcy. That's the latest casualty of the $2 trillion crash that has wiped out some of the industry's biggest names and exposed hundreds of thousands of individual investors to steep losses. Celsius, which has more than 100,000 creditors, said it took the step to stabilise its business and work out a restructuring for all stakeholders. The filing was made in the Southern District of New York and listed Alameda Research, the trading firm co-founded by crypto billionaire Sam Bankman-Fried, among major creditors. The platform held about $4.3 billion of assets against $5.5 billion of liabilities as at Wednesday last week, according to court papers. And the company has been trying to obtain new financing from third parties, but those talks made clear that a bankruptcy filing was necessary, Chief Executive Officer Alex Mashinsky said in a sworn declaration. Crypto lender Celsius Network has revealed a $1.2 billion hole in its balance sheet caused by what the chief executive calls poor investments and other unanticipated losses. Celsius made the disclosure as it sought US bankruptcy protection this week after freezing customer funds in June, which made it the latest victim of the crash in crypto markets that has forced two other large companies into recent bankruptcy. Celsius was one of a handful of crypto lenders that pulled in billions of dollars worth of assets from ordinary investors in recent years. And the CEO, who co-founded Celsius in 2017, laid bare the scale of the New Jersey-based company's problems in a 61-page court filing on Thursday. It showed liabilities of $5.5 billion US and assets of just $4.3 billion. The vast majority of the liabilities, around $4.7 billion, were attributed to Celsius users. The filing suggested they may face similar losses and blame the company's problems on a mixture of bad bets, market conditions, and a failure to manage its rapid growth. The amount of digital assets on Celsius's platform grew faster than the company was prepared to deploy. As a result, the company made what, in hindsight, proved to be certain poor asset deploying decisions, Mashinsky wrote in the filing. Celsius was one of a handful of crypto lenders that pulled in billions of dollars worth of assets from ordinary investors in recent years, and it promised interest rates as high as 18% on certain cryptocurrencies. Canada's second largest pension fund, Caisse de Placement de Québec, and investment firm Westcap lent $600 million US equity funding in the round last year that valued Celsius at $3 billion US. The lender is the third big crypto company to file for bankruptcy, following crypto broker Voyager Digital and hedge fund Three Arrows Capital. All three have been hit by collapsing crypto asset prices and a freeze in credit in the market. Mashinsky admitted a series of mistakes that had resulted in losses and detailed investments that had left Celsius unable to return money to customers as it suffered a bank run this year. One was a $510 million loss discovered in 2021 when Celsius sought to recover collateral that it had pledged to cover borrowings from an unnamed private lending platform. The lender was unable to return the collateral on a timely basis, the CEO wrote. About $440 million US of that remains outstanding. Celsius also incurred losses of around $100 million when collateral that it had pledged to secure a loan from Tether, the stablecoin issuer that is an equity investor in Celsius, was liquidated by mutual agreement in recent months. Mashinsky said that about $1 billion US of Celsius funds were illiquid as they had been committed to the company's Bitcoin mining operation or investment in a version of the Ethereum network that had not been launched. He suggested Celsius' recovery plan could involve using Bitcoin generated from its mining operations to address its current cryptocurrency deficit. As well as admitting the company's mistakes, he blamed misinformation in the media and on social media for encouraging customers to pull about $1 billion worth of funds over 5 days in May. Since he said Celsius had been on its way to tackling its problems when the market turned this year, the company believes that it would have likely succeeded in the near future if the market had remained relatively stable. And doubts about the sky-high values backing products such as those that Celsius offered intensified after the collapse of the Terra USD algorithmic stablecoin in May. Another centralized lender, Babel, has also halted withdrawals, and crypto prices have slumped, with Bitcoin and Ethereum losing half their value since the end of December. For Celsius, its business was built on loaning crypto borrowed from its customers to institutional investors, and it was also a participant in a slew of decentralized finance applications. In a statement on Wednesday, Celsius said it needed to halt withdrawals, as without it, an acceleration of the pullouts would have allowed certain customers, those who were first to act, to be paid in full, while leaving others behind to wait for Celsius to harvest value from illiquid or longer-term asset deployment activities before they received a recovery. The co-founder said that the statement would strengthen the future of the company, and the firm has petitioned to continue to operate. It wasn't requesting authority to allow customers withdrawals right now, saying the claims would be handled through the Chapter 11 process. Kirkland & Ellis is serving as legal counsel, with Centerview Partners, a financial advisor, and Alvarez & Marshall, a restructuring advisor to Celsius. Bankruptcy processes can take a while to resolve. Creditors of Mt. Gox, at one time the world's biggest Bitcoin exchange that closed doors in 2014 and began liquidation proceedings, have yet to be paid. How much and what Celsius users will recover is unclear. Under its terms of service, treatment of its customers' digital assets in case of insolvency is unsettled and not guaranteed, which may result in customers being treated as unsecured creditors. When the Terra USD stablecoin and related lunar tokens collapsed in May, Celsius scrambled to pull its funds out of Terra's Anchor protocol, which offered 20% returns on UST deposits. And more recently, it suffered as another large holding, a token known as State ETH, or STETH, which is tied to the value of Ether, became largely illiquid and more widely discounted to Ether. In the past month, Celsius paid back all, more than $900 million, of its debt to decentralized application Aave, Compound, and MakerDAO, according to blockchain data and tracker Zappa. The paydowns have raised the spectre of a legal debate on how and in what order should distressed crypto companies pay back creditors, whether they're actually people or platforms governed by computer code referred to as smart contracts. And an already beleaguered crypto mining sector could also be facing some additional pressure from the Celsius Network bankruptcy filing. Celsius Mining said in the filing that it owns 80,850 rigs with 43,632 in operation and expects to run about 120,000 rigs and generate more than 10,000 coins by the end of this year. That would make the unit one of the biggest Bitcoin miners, which use energy-intensive computers to process records of transactions and earn rewards in the virtual currency. Industry observers have speculated that the mining business could be for sale as a way to raise cash since Celsius halted investor withdrawals last month. Besides any bankruptcy-related complications that may now arise, a possible offloading of the rigs could prove to be troublesome. Celsius Mining selling machines would add downward pressure to already falling machine prices, said Matthew Kimmel, digital asset analyst at CoinShares. The bankruptcy comes as the value of mining rigs plunge, with Bitcoin prices in sharp decline. Some of the most popular machine models have fallen as much as 50% since the last bull run, and miners are struggling to complete purchase orders they made several months ago. Miners in Texas shut down this week because of the stress on the local power grid. Our trading desk usually sees a 10 to 15% slippage of the market of a sell order if the machines want to move quickly, said Ethan Vera, Chief Operations Officer at crypto mining service provider Luxor Technologies. This will likely represent a 60 to 70% loss on their initial investment. And the Jersey City, New Jersey-based firm had been touting the unit as an attractive strategic asset. Celsius invested about $500 million in Celsius Mining and even prepared it for an initial public offering in May. The mining center is an essential driver of growth in the debtors' business and will allow the debtors to expand and more profitably mine Bitcoin, according to the filing. Celsius Mining has also started building a mining facility in Texas with 4 sites where it could host over a quarter of the company's rigs. The company engaged vendors to procure and provide goods and services for the construction, which could be completed in the coming weeks, according to the filing. And in June, the company sold at least 7,000 rigs through a confidential auction before it filed for bankruptcy, according to CoinDesk. However, it remains unclear whether Celsius will completely sell or continue its mining unit after the restructuring process. It seems Celsius is aiming to continue at least part of the Celsius mining operations following the restructuring as a means of generating Bitcoin rewards and to pay down some of their outstanding liabilities, Kimmel said. Even with the price of Bitcoin down around 7% from November highs and many miners struggling, Kimmel said the asset may still prove to be attractive if Celsius decides to shed them. This may present a good opportunity for well-capitalized miners to expand depending on their ability to deploy, electricity costs, and the efficiency of Celsius machines, he said. And once again, I want to highlight how interconnected this whole crypto situation is, with many large entities cross-invested in other crypto entities, and of course none of this publicly disclosed and with no regulation. No wonder we're going to see more grief ahead. And I'm pretty sure that we're going to see more bankruptcies ahead as well. And the bottom line is this: many end holders of cryptocurrencies will have to assume they're going to take further losses ahead one way or another. This whole situation looks to me to be cascading towards a very significant tipping point. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.